Have you ever had that feeling that a huge economic shift is happening, right under the surface? Something that could totally change what we value for the next 10 years. Well, today we're going to dig into a really big one, the idea of a new commodity supercycle. Let's get right into it.
Okay, so take a look at this chart. Seriously, just look at it. It shows the value of raw materials, the actual stuff that builds our world compared to the S&P 500. And as you can see, that ratio has completely fallen off a cliff. What this means is that commodities are cheaper relative to stocks than they have been at any point in the last half century.
So, you gotta ask, what on earth is this chart screaming at us? Is this just some weird historic blip, or is it a massive signal that something is about to fundamentally change? Let's break it down.
So, the first piece of this whole puzzle is a huge problem that's been building quietly for years, a massive structural squeeze on the supply of the things we absolutely need.
To really get what this supply problem looks like, let's zoom in on this other chart, which uses uranium as a perfect example. See that top line? That's the demand for nuclear fuel, and it's just steadily climbing. Now look at the line below it. That's the supply, and it is seriously struggling to keep up. That growing gap between them, that's the supply squeeze in action. And this story is repeating itself across all sorts of different commodities.
And just so we're all on the same page here, U3O8, which you might know as yellow cake, is basically the raw ingredient for nuclear power plants. It's absolutely critical for our energy future.
Look, this isn't some accident. It's not a fluke. This is the result of something that's been happening for more than a decade. We've just stopped investing in finding and digging up the raw materials that our entire global economy is built on.
So why? Why did this happen? Well, after the big commodity crash between 2008 and 2015, a lot of the mining companies got spooked and just slashed their spending. At the very same time, environmental rules got a lot stricter, getting a permit for a new mine started taking forever, and frankly, we'd already mined most of the easy-to-get stuff.
And this number right here really shows you how big the problem is. Even if prices for this stuff went through the roof tomorrow, it can take anywhere from 7 to 15 years to get a new mine from the moment you discover it to the moment it actually produces anything. You just can't flip a switch and get more supply.
Okay, so that's the supply side of the equation. It's been squeezed for years. Now let's look at the other side. Because while supply is constrained, demand is getting ready to absolutely explode for some really powerful reasons.
Just think about it for a second. The green energy transition. It needs an insane amount of copper for all the wiring, lithium and nickel for batteries. Nuclear power is making a huge comeback. We're trying to electrify everything, from our cars to how we heat our homes. And on top of all that, billions of people in emerging countries want the same kind of life we have. All of that. It all requires physical stuff.
And hey, don't just take my word for it. The International Energy Agency did the math, and they figured out that to hit our climate goals, we're going to need 6 times the amount of key minerals by 2040. 6 times! That is a staggering wave of demand about to crash into a supply chain that's already crippled.
Okay, let's go back to that very first chart, the one that got this whole thing started. What happened in the past when the value of commodities got this ridiculously low compared to stocks?
Well, history gives us some pretty fascinating clues. Take a look at the major low points on this timeline. The last time this ratio got this low was right before the 1973 oil crisis, which sent commodity prices to the moon. We saw similar patterns after the lows in 2000 and right before 2008. Every single time, a period where commodities were super cheap was followed by a massive rally. And now look, all the way to the right. Today, the ratio is lower than it has ever been.
So the main point here, the really crucial thing, is that these massive gaps between the financial world and the physical world, they don't tend to last. Historically, they have always snapped back, and sometimes they snap back really violently.
So, this brings us to the core idea. All this evidence is pointing to the possibility that we're not just heading for another little price spike, but maybe something much, much bigger.
Here's why this time might actually be different. You see, past booms were usually triggered by short-term shocks, like a war or a political crisis. The argument today is that we have a perfect storm, a deep, structural lack of supply hitting head-on with massive, long-term, irreversible demand growth. That isn't a recipe for a quick spike. That could be a recipe for a whole new era of higher prices.
Now, of course, this is not a sure thing. There are definitely risks to this whole idea. A really bad global recession could crush demand, a huge technological breakthrough in, say, recycling could change the math entirely, and of course things like China's economy and what central banks do with interest rates will always play a massive role. But when you put all the pieces together, the big takeaway is this. We could be in the very early stages of a massive rebalancing, a true tectonic shift in value, away from the digital and financial things that have been king for a decade and back towards the tangible, physical assets that actually build and power our world.
Which leaves us with one last fascinating question to think about. After a decade of celebrating software, data, and the digital world, are we about to get a very powerful reminder that the real world, the world of copper and oil and food, is what truly matters?